Good Saturday morning, automotive enthusiasts. I'm Steve, joined by my colleague Claire, and you're tuned in to the Auto Intelligence Podcast, your definitive source for the latest industry insights, dropping every Tuesday, Thursday, and Saturday.
If you're starting your weekend with your favorite morning brew, you've picked the perfect companion to kickstart your day with fresh automotive perspectives. Today, we're tackling what might be the most significant transformation in the automotive industry since the globalization wave of the 1990s, the great automotive disruption of 2025.
It truly is momentous, Claire. The global automotive industry stands at an unprecedented inflection point, where traditional manufacturing paradigms are colliding with revolutionary technological advances and shifting geopolitical realities. S&P Global Mobility Project's global vehicle sales will reach 89.6 million units this year, reflecting a modest 1.7% growth amid complex market dynamics.
But that headline figure masks dramatic regional variations and technological shifts reshaping the industry landscape. We're going to break down the three critical forces accelerating this transformation: manufacturing economics, technology integration, and the retail revolution. And we've got a packed show today. We'll be diving deep into each of these areas with exclusive insights and expert perspectives.
Let's start with manufacturing economics. The implementation of 25% tariffs on vehicles and parts has triggered what experts are calling the most significant restructuring of automotive supply chains since World War II. Industry analysts at McKinsey & Company estimate this reorganization carries a collective price tag of $178 billion in immediate infrastructure investment and supply chain redesign costs.
Absolutely. These tariffs are forcing manufacturers to reconsider decades-old production strategies and invest heavily in supply chain resilience. The immediate impact is staggering. Production cuts of 944,000 units in North America alone, average vehicle price increases between $3,000 and $9,000, and premium vehicles facing up to $10,000 in cost increases.
Dr. Sarah Chen, chief economist at Global Auto Analytics, describes it as the most significant restructuring of automotive supply chains since World War II. She notes that companies are now deploying advanced AI-powered logistics modeling to simulate hundreds of production scenarios daily, seeking the optimal balance between tariff exposure, skilled labor access, and proximity to growth markets.
Manufacturers are pursuing three primary strategies to navigate this new landscape. Let's break these down one by one.
First is supply chain regionalization, which includes shifting production to tariff-friendly zones, building regional supplier networks, and increasing inventory buffers by 30 to 40%, according to logistics platform Orderful.
Second is cost management through AI-driven logistics optimization, renegotiating supplier contracts, and exploring alternative materials and designs. AlixPartners reports that manufacturers implementing these strategies are seeing cost reductions of 15 to 22% in their logistics operations.
And third is long-term infrastructure investment, with new U.S. plants requiring over $1 billion investment, a 2 to 3 year timeline for facility completion, and a focus on flexible manufacturing capabilities. AutoWeek reports that at least 7 major automotive manufacturers have announced new North American production facilities in response to the tariff situation.
And we can't overlook the human impact. An estimated 28,000 automotive jobs are in flux across North America as production shifts to new locations and requires different skill sets. That's according to Brady Martz's latest industry report. Assembly line workers in Michigan, Ontario, and Aguascalientes find themselves navigating an industry where geographic certainty, once a hallmark of automotive careers, has evaporated.
Now, let's turn to global market dynamics, particularly China's evolving role. China's position in the global automotive landscape has strengthened considerably in 2025, fundamentally reshaping industry dynamics. It's what automotive historian Dr. Robert Martinez calls the kind of generational transformation that previously occurred when production moved from Europe to America in the early 20th century and then partially to Japan in the 1970s and 80s.
The numbers tell the story. China now controls 53.6% of global battery electric vehicle sales, 73.1% of plug-in hybrid electric vehicle sales, and nearly 50% of new car sales in China are electric vehicles. AutoVista24 reports that this represents the fastest technological adoption in automotive history.
What's particularly noteworthy is a stunning reversal from just 5 years ago when Western and Japanese manufacturers still dictated industry standards and production volumes. Chinese brands are rapidly expanding globally, with BYD surpassing Volkswagen as the world's second-largest automaker. Their export numbers reached 5 million vehicles in 2023, overtaking Japan as the top auto exporter.
And they've been strategic about it, establishing manufacturing hubs in Mexico and Turkey that help circumvent tariffs while maintaining cost advantages. Chinese manufacturers have been particularly effective in emerging markets across Southeast Asia, Latin America, and Africa, where BYD and NIO now command 37% market share combined.
What's interesting about their approach is how they pair affordable EV models with proprietary charging infrastructure that creates powerful ecosystem lock-in with consumers. It's similar to Apple's strategy in consumer electronics. Create an integrated ecosystem that makes it difficult to switch to competitors.
China's grip on critical EV components remains formidable. 75% of global lithium-ion battery production, 70% of lithium refining capacity, 85% of cobalt processing, and 60% of global graphite output. China Briefing reports that Chinese companies have secured mining rights to an estimated 60% of the world's lithium reserves over the past 5 years.
As Dr. Michael Robertson of the International Battery Alliance puts it, whoever controls the battery supply chain essentially controls the future of mobility. This battery dominance gives Chinese manufacturers a 22 to 27% cost advantage in EV production, a gap Western manufacturers have struggled to close despite substantial investments.
The battery manufacturing scale is particularly impressive. KTL's Ningde facility produces 145 gigawatt-hours annually, over 14 times the average US plant's output. They've also pioneered LFP batteries that cost $5,000 less per vehicle than nickel-based alternatives, and their mid-nickel batteries now use 50% less cobalt, according to Motor Finance Online.
Let's shift gears to talk about the electric vehicle landscape, which is experiencing particular turbulence in 2025. While electrified vehicles, including hybrids, are expected to comprise 25% of U.S. sales, pure EV adoption faces significant challenges.
That's right. EV retail share has stagnated at 9.1% in 2025. Hybrid sales growth outpaces pure EVs at 47% versus 20%. And remarkably, Tesla sales are declining 26% from 2023 peaks. And this is happening across all price points and vehicle segments, suggesting it's not just an affordability issue.
This stagnation comes despite federal tax incentives worth up to $7,500 per vehicle and over $14 billion invested in public charging infrastructure since 2022. A J.D. Power study released just last month found that while 68% of Americans express interest in EV ownership, only 23% actively consider purchasing one when entering the market.
It's what Emily Thornton, Chief Strategy Officer at Volkswagen Group America, calls a reality check for the industry. She notes that they underestimated consumer concerns about charging infrastructure reliability, battery longevity, and resale values. The market is telling us that hybrids represent the comfort zone for most consumers today, offering a bridge technology with fewer perceived risks.
Despite these challenges, there's exciting innovation happening in battery technology. Massachusetts-based Quantum Cell has emerged as a surprise leader in solid-state technology, securing $2.8 billion in venture funding and partnership agreements with 3 major automakers. What makes their approach unique is their use of a ceramic electrolyte material that solves many of the temperature sensitivity and manufacturing challenges that have plagued other solid-state designs.
Their prototype batteries have completed over 1,500 charging cycles while maintaining 92% capacity, a significant improvement over current lithium-ion technology. For context, most current EV batteries begin showing significant degradation after 800 to 1,000 cycles.
As Quantum Cell founder Dr. Alessandro Rossi puts it, we're finally approaching the battery chemistry that makes true 500-mile range affordable and practical. This isn't incremental improvement, it's the step change the industry has been waiting for.
Other key technological developments include sodium-ion alternatives, gaining traction as a lithium alternative, particularly for energy storage applications, and recycling projected to supply 20% of battery materials by 2035, according to Bloomberg NF. These circularity initiatives are crucial for addressing long-term resource constraints.
You're listening to Auto Intelligence, sponsored by Agentic, the pioneering agentic AI platform revolutionizing automotive retail. Unlike typical AI solutions, Agentic is LLM agnostic and deeply trained in the auto industry.
Agentic's intelligent agents nurture leads, optimize inventory, manage service appointments, and handle customer follow-ups. What's critically important is that Agentic is built to enhance your team's abilities and performance, not replace them. That's why they're known as the most human AI company in the automotive space. Now let's continue our discussion about the software-defined vehicle revolution.
Now let's talk about what might be the most transformative shift, the rise of software-defined vehicles, or SDVs. This marks a fundamental shift in automotive architecture, with the market projected to grow from $213.5 billion in 2024 to over $1.16 trillion by 2030.
We're seeing a reduction from 100 electronic control units to fewer than 20 centralized computers, over-the-air updates enabling continuous feature upgrades, and AI integration for autonomous driving and performance optimization. PTC, a leading industrial software company, describes this as the most fundamental architectural change in automobiles since electronic fuel injection replaced carburetors.
A perfect example is the 2025 Ford Mustang Mach-E GT, which now runs on a unified software platform called Blue Oval Intelligence that manages everything from battery thermal management to driver assistance systems. The car literally improves while sitting in your garage, with Ford pushing an average of 14 feature updates monthly to its connected fleet.
This architectural transformation is creating what industry insiders call the smartphone effect. Consumers now evaluate vehicles based on their software capabilities and update potential, not just their physical characteristics. Just as we expect our phones to improve with updates, consumers now have the same expectation for their vehicles.
This transformation is reshaping workforce requirements too. General Motors now employs more software engineers, 11,400 of them, than mechanical engineers at 9,800. Traditional automakers are rapidly transforming into technology companies that happen to manufacture vehicles.
The race to secure AI talent is particularly fierce. Mercedes-Benz recently established a Silicon Valley campus offering compensation packages 35% above tech industry standards, complete with equity positions and autonomous project freedom. Their CTO Marcus Schaefer admits they're competing directly with Google and Nvidia for the same talent pool. Without these engineers, we simply cannot build competitive vehicles for the next decade. Finally, let's look at how dealerships are evolving through AI integration. The automotive retail landscape is experiencing its most profound transformation since the franchise system emerged in the early 20th century.
The numbers are impressive. 100% of AI implementing dealers reported revenue growth, 55% achieved increases exceeding 20%, and service departments are generating 95+ additional repair orders monthly. Impel, a leading automotive retail technology provider, notes that dealers who implemented their AI platform saw customer satisfaction scores increase by 31% within the first 6 months.
We're seeing 27% higher appointment set rates, 26% improved closing rates, and 24% better customer retention, according to Fullpath's 2025 Automotive Retail Technology Impact Report. At Toyota of Orlando, an AI assistant named Tori now handles 78% of initial customer inquiries, appointment scheduling, and basic vehicle information requests, reducing response times from hours to seconds.
It's a massive shift. As Thomas Jenkins, who operates a multi-brand dealership group in Arizona, explains, we've gone from inventory-heavy businesses focused on moving metal to technology-enabled service providers who occasionally sell vehicles. It's a complete paradigm shift.
While 81% of dealerships plan to increase their AI technology budgets in 2025, the transition isn't without hurdles. Implementation costs vary significantly based on the sophistication of the systems. Despite these costs, the return on investment is compelling. Service departments have emerged as the unexpected heroes of the dealership transformation. With new vehicle prices climbing and consumers keeping vehicles longer, the average age of vehicles on American roads hit 12.5 years in 2025. Service revenue has grown by double digits at most dealerships.
The most successful dealers are embracing subscription models for routine maintenance, creating predictable revenue streams and stronger customer relationships. AutoNation reports that its Total Care subscription program now accounts for 34% of service revenue across its 230 locations, with subscriber retention rates exceeding 88% annually.
Let's look ahead at what's coming for the industry beyond 2025. Industry revenue is projected to reach $2.6 trillion this year, growing to $2.66 trillion by 2026. However, this growth comes with significant regional variations.
In the Asia-Pacific region, which maintains 50% of global sales, China's dominance in EVs continues despite domestic competition. Meanwhile, India has emerged as the fastest-growing major market with 8.2% year-over-year growth, according to Focus 2 Move. Their domestic manufacturers like Tata Motors are rapidly expanding EV offerings tailored specifically for local conditions.
Europe faces unique challenges, with production cuts of 12,000 to 251,000 units anticipated through 2026. The EU's carbon border adjustment mechanism is creating new complexities for manufacturers, and European producers continue to grapple with energy costs that are 2.4 times higher than their American counterparts, according to Denton's latest industry analysis.
North America continues to face supply chain reorganization and tariff impacts, with hybrid vehicle demand outpacing pure EVs. We're also seeing accelerated dealership consolidation, with Cox Automotive reporting that the number of dealership groups controlling 10 or more stores has increased by 22% in just the past 2 years.
The most promising developments center around sustainability and circular economy principles. BMW's Second Life program is achieving 91% battery component recovery, while Toyota's Environmental Challenge 2035 is targeting carbon-negative operations.
We're also seeing AI-driven manufacturing boosting productivity by 20 to 30%. Cross-industry data-sharing platforms like Katina X emerging to improve supply chain visibility, and smart factory implementations reducing energy consumption by 35%, according to SG Analytics.
As we wrap up today's episode, it's clear that the automotive industry is experiencing a transformation that represents both the greatest challenge and opportunity in a century of automotive manufacturing.
Success in this new landscape requires agile supply chain management, strategic partnerships across regions, investment in software and AI capabilities, and a focus on sustainability and circular economy principles.
For consumers, this transformation promises vehicles that are smarter, more sustainable, and increasingly personalized. The winners will be those who can navigate the complex intersection of geopolitics, technology, and changing consumer preferences.
One thing is certain. The vehicles that emerge from this transformative era will bear little resemblance to those that came before, not just in their powertrains, but in their very identity as products. The car of tomorrow will be a software platform, an energy management system, and a mobility solution, all wrapped in sheet metal that serves increasingly as a canvas for technology rather than its container.
As Akio Toyoda, chairman of Toyota Motor Corporation, predicts, the companies that will thrive in this new environment are those that embrace 3 fundamental shifts. First, they must rethink their entire supply chain through a sustainability lens. Second, they must master software development as a core competency. And third, they must build direct, ongoing relationships with consumers that transcend the traditional sales transaction.
You've been listening to Auto Intelligence, sponsored by Auto Agentic, the suite of intelligent agents designed specifically for modern automotive retail challenges.
Auto Agentic is a pioneering agentic AI-driven platform transforming the automotive retail industry. Founded in 2024, the company delivers intelligent, adaptive solutions designed to help dealerships streamline operations, optimize sales performance, and elevate the customer experience.
With a focus on ethical AI, seamless integrations, and real-time data insights, Auto Agentic empowers dealership teams, not replaces them, unlocking new levels of productivity and profitability. What makes Auto Agentic unique is that it's an agentic AI solution that's LLM agnostic and deeply trained in the auto industry, handling everything from inventory optimization to service appointment management and customer follow-ups.
By enhancing decision-making with advanced analytics, Auto-Agentic helps dealerships stay competitive in a rapidly evolving market. Unlike typical generative AI solutions based on ChatGPT that flood the market today, Auto-Agentic is built to enhance your team's abilities and performance, not replace them. That's why they're known as the most human AI company in the automotive space.
While generative AI merely responds to prompts, Auto-Agentic's solution proactively takes action on behalf of dealerships, working alongside your team, and learning from outcomes to continuously improve performance. This distinction is crucial for dealers who need AI that doesn't just suggest actions, but actually implements them to drive real business results. Visit us at autoagentic.ai.
And until next time, remember to like, comment, and subscribe to Auto Intelligence. Thanks for listening.